So we started with the advantage of time, which is one edge. Second is the whole concept of terminal value investing, where you identify perhaps the potential of the company based on your understanding of the landscape, whether it is macro, whether it is ability of the management, or whether it is the size of the opportunity. But its terminal value is more than that, right? Like you said, that it is not a mathematical formula. It cannot be interpreted with a P multiple. It is not the enterprise value of a company, or it is not the replacement cost of a company.
So Nikunj, let me actually use the framework that this actor Matthew McConaughey, I hope I'm pronouncing that name right, he said in his speech while accepting the Oscar award in 2014. He says everybody in his life has someone to look up to, which is God or your ancestors, someone to look forward to. In his case, he said it was his family, but most of all, someone to chase. And when he was asked, who is it that you are chasing? He said, I am chasing my hero. And he was asked, who was the hero? He says, my hero is the best version of me 10 years from now. He said that he was asked that question when he was 15. So at the age of 25, the same gentleman walks up to him and asks him the same question. Are you your hero now? And he says, no, because the one that I am chasing has also moved 10 years in the last 10 years. So I am still chasing the best version of me 10 years from now. In the same way, we are continuously chasing this terminal value, and that terminal value keeps moving as we keep moving in time. In the conventional value investing framework, one is seeking a value arbitrage, really speaking, where you are saying that I want to buy at a price at time t0, which is, let us say, today, as compared to the value that I see at time t0, which is also today. I am looking to take advantage of that gap. However, in terminal value investing, we are actually pursuing a very different value. We are saying I am comparing the price at time t0 to, let us say, in 2024, to the terminal value that I perceive at time t10, which is in this case 2034. So long as that gap is very wide, and I do not need to know the precise quantum, right. As they say, it is better to be vaguely correct than to be precisely wrong. One pursues that terminal value, which is 10 years out. 10 years is an arbitrary number. It is long enough for me. Maybe somebody else might want to think of a different time frame. But when you do this, then your mind is at peace, wherein you are not focusing on the next quarter's earnings, nor are you focusing on macro factors, change in interest rates, change in growth rates, tax collections, this, that, and the other. You are focused on that terminal value.
If I could encourage you to perhaps talk about, let us say, a macro example or a company specific example, local or global, how would you just capture this for the viewers?
Right. So Nikunj, I don't know if you recollect, but sometime in June 2002, Rakesh and I wrote an article for Economic Times, which was published in his name, about how he foresaw a structural and secular bull market in India. That was way back in 2002.
Now we get goosebumps if we read it.
Right. In his mind, that was the terminal value of India, right. He was pursuing that terminal value. He was not thinking that I will make a 30% return here and a 20% return there. He just took a real long-term view. The words that we chose, structural and secular, are important. He could have just used the word bull market. But I think very consciously we chose those two words, structural and secular. And again, apart from this example, let me give you some other example also, which is also in the public domain, and I am not naming companies here. But one of the best investments for rare in the public market space, Rakesh ji invested in that at, let's say, a price X. But over time, as his conviction kept on increasing, he kept on buying at higher levels as well. What is most noteworthy is that he bought more of that company, not just at higher prices ordinarily, but he bought it, more of it, even at 30x of his first purchase price. Most people actually sell at 30% upside. He was buying more at 30x of his first purchase. That is the power of his conviction in the terminal value of that company.
So is terminal value more like a call which is not derived on mathematics, it is not derived on P multiple, it is purely your imagination on how you perceive things could go for that trend, for the country or for the company. So then it's like you painting a picture in your mind which may hold true, which may not hold true.
True. You are very right, Nikunj. So, but I would go beyond imagination. Imagination is free flow and does not have to be anchored on trends and does not have to be anchored on some inferences. Here, the terminal value that an investor should conceive of should be on the basis of some trends, on the basis of some inferences, on the basis of some analysis. Because at the end of the day, you are betting on the probability of that terminal value, not just the terminal value, but also the probability of that terminal value playing out. Because no matter what you imagine, if that terminal value does not play out, it does not help you as an investor. So I would say probability of that terminal value is equally important.
But you spoke about an...
If you like this video, then like, share and subscribe to ET Now.